Hi, everyone. Welcome to the latest Carson's Take 5. Ryan and Sonu here. Sonu, things have been good. We've been bullish. We've talked about that a lot. But there's always worries. So this week, we're going to talk about some worries that we have as it pertains out there. I guess the time you and I were recording this, we saw some inflation data that was a little bit on the hot side. Now, we've seen that before early in the year. It turns out companies increase prices early in the year, but it always seems to surprise everybody. How worried are you about inflation?
I'm not worried about inflation itself, the actual inflation, like what's happening. And I think I've shared this before. Like, we didn't think inflation was a problem this time last year. Even, we thought inflation was coming down 2 years ago this time.
Yeah.
What I am worried about is that the Fed looks at the data and says, you know what, things are a little too hot here.
Yeah.
Right. And optically, it's a perception of the inflation numbers, right? Core inflation is running about 3%. Core inflation meaning, you're taking out food and energy. But even if you include food and energy, it's running at 3%. There are reasons why, right? Shelter inflation. You and I have talked about that. That is contributing a lot to that excess inflation. Before the pandemic, here it is, really quick, some numbers. CPI, headline consumer price index. In 2019, December, it was up 2.2%. Let's say, okay, that's a normal. Where are we right now? 3%. What's the difference? 0.8 percentage points. What's contributing to that? Two things. One is shelter inflation, right? And we know that's lagging. We know the government's data is not capturing what's happening in reality. The other is motor vehicle insurance. That is also lagging, right? I don't think these are actual real problems that we're having with respect to inflation today. Real problems that we're having is maybe egg prices. That's up a lot. You know, and then the other thing, maybe, there are always pockets which worry us, like energy prices, things like that. But overall, I don't think you have an inflation problem. But I worry that the Fed looks at it and says, you know what, we're going to hold back on cutting interest rates.
Got it. Yeah, and obviously the market's hoping for some cuts, and if you get better inflation data, you might see that. So that's definitely one potential worry out there. One that I have is simply the calendar, right? The month of February, where we are right now, in a post-election year, is the worst month of the year. The last 10 years, last 20 years, last 50 years, February consistently is one of the worst months again. But in this type of year, post-election year, it's the worst month on average. Again, there's something to think about here. Also, the first quarter, Sonu, of a post-election year, if you look at all 16 quarters of a 4-year presidential cycle, is historically quite weak. So that's just something to think about here. Not the end of the world. Stocks gained 20% 2 years in a row. Maybe we're due for a little bit of consolidation. One more, and I'll try to keep this fairly simple. If we look at how many stocks are going up versus down, you want to see a lot of stocks going up. That's called participation. We've had some participation, but I'd like to see just a little bit more. Where the stock market's flirting at all-time highs, I don't think we're having quite as many stocks that are going up as I'd like to see. Not as many 52-week highs as I'd like to see. Doesn't mean it's not going to happen. I think it will. But that is one concern of mine, again, that maybe under the surface is a little bit weaker. And that kind of fits in with the idea that, you know what, maybe February, March in a post-election year might be a little choppy. That's kind of where we are. What are some other worries you have?
The other thing is, remember, we titled our Outlook 2025 Animal Spirits.
Yeah.
And which wasn't to say we thought animal spirits were going to take off, anything like that. But we thought there was a good chance of that. So far, 40 plus days, 45 days into this year, yet to see that, right? Consumer confidence is still kind of lagging.
Yeah.
Right. Business confidence is also not quite up there. Right. So, obviously we can point to tariffs, some uncertainty related to that. But I think also interest rates, right? Look, when consumers feel stuck, and I think a lot of people who probably want to change homes, for example, feel stuck because you have a 3% mortgage. If you want to buy a new home, if you want to move with your family, you have to swap that 3% mortgage rate for a 7% mortgage rate. That is not going to make anyone happy about their future prospects, right? So I think that's one reason. Elevated interest rates, it goes back to what we were talking about with the Fed, right? I think elevated interest rates are a problem. That's probably why consumer confidence really hasn't taken off, right? And business confidence, I think, is getting hit at the margin by both interest rates, but I think also tariff uncertainty. So, without getting into tariffs and all that, because there's so much we don't know.
Sure.
But I don't think the uncertainty helps animal spirits.
No, well said. And one more, I guess, potential worry. Earnings season was overall solid, but if you look at some of the large technology names like the Mag 7, I'm not going to mention them now, but you probably know who are in the Mag 7, names you've heard and loved before. Their earnings were good, but the market kind of sold off on a lot of these big tech names, which have been so influential in the overall stock market going higher. Now, let's be clear. We're still positive, though, in the overall stock market because maybe technology isn't as rip-roaring leader like it was, just more market neutral. That's okay. But things like financials, industrials, other areas have taken the baton. So that's a good sign. At the same time, a lot of investors, a lot of listeners out there have a lot of tech exposure. So if tech were to lag a little bit, and honest to goodness, it has been, really since the fourth quarter of last year, that could upset some investors out there. And is a potential worry as well. But again, just to put a bow on this, I know we've hit about the 5-minute mark. This is still a bull market. We still see more positives and negatives out there. We just wanted to mix it up and have a little fun and talk about some of the worries out there. And speaking of fun, one more.
Okay.
When a team from Philadelphia wins a World Series or a Super Bowl, really bad things happen. The Phillies, which is a team or not the Phillies, apologies, Athletics, which is in Philadelphia, won a World Series in 1910, 1911. Panic of 1910, 1911. 1929, 1930, another World Series for the city brotherly love. You know what happened? Great Depression. 1980, Phillies won a World Series. Yeah, there's a double dip recession, a really bad time. 2008, Phillies won a World Series. Yeah, that wasn't too good. Then in 2018, the Eagles won their first Super Bowl. That was a negative year, and another trade war and tariff issues back in 2018. I say that. So 2018 is when they won the Super Bowl. Sorry. And then they just had one. They just won a Super Bowl. Of course, that's playful. Don't ever invest in those things.
If you're sitting in Philadelphia, we love you. So.
Yeah, Philadelphia, you've earned it. So congratulations there. Just playful thing that when Philly wins, bad things happen. But you know what? That's not a real worry. The real worry is we still think this is a bull market, and we think maybe not enough people don't agree with that and still disagree. There are worries, there are concerns, but there's still more positives. With all of that, everyone, this is the latest Carson's Take 5 with Ryan and Sonu. See you next week. Thank you.